Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So with the housing market changing dramatically in the buyer's favor, buyers have a lot more options these days. And I've been getting questions all the time about new construction. What do I do, Brian? Do I buy the lot first, the land first, do the construction loan second? How does it all work? So if you're looking for new construction and you got questions, stick around. My video has answers. So we all know the housing market in Dallas has cooled off. It's given buyers an opportunity finally to get their hands on a home, and a lot of them are getting good deals on homes. But one of the challenging things about a market that still is a little thin on inventory is new construction. And new construction is super popular. And as a buyer, you know, there's no way to know when buying a new construction home, how does it all work, right? Does the builder pay for it? Do I, as the buyer, have to get a loan? Everything in between. So I want to give you guys a couple tips and tricks on how new construction stuff works. So depending upon the path that you choose, if you choose new construction, you can know what to expect and you can know what to be prepared for when it comes to getting a home loan. So, number one, all mainstream big builders, Grand Homes, Lennar Homes, D.R. Horton Homes, when you are a buyer and you go to their subdivision to buy a property, to walk a property, you never have to worry about getting any of the land loans. You never have to worry about getting any of the construction loans. Those big builders take care of all that for you. Now, there's a little bit of risk associated with that with the builder. So a lot of times if they're going to finance the property and the building of the property, they're going to make a little money on the back end because they're obviously absorbing all the risk when it comes to the money piece. But majority of the time when you go with those traditional builders, they're going to be the ones who are going to build the property and finance the property for you. So when you go in to see a sales rep at a new construction site, you know, one of the questions they're probably going to ask you up front is, hey, are you pre-approved? If you're pre-approved, great. If you're not, they're probably going to say, hey, you know, try to get pre-approved with our person that we prefer here. You know, at our mortgage company, they'll give you some incentives, blah, blah, blah. But when that mortgage person or another mortgage person pre-approves you when you're doing a new construction house, they're not pre-approving you for the construction piece, the land piece, the lot piece, and the constructing of the house. They're pre-approving you for the permanent piece on the back end. Meaning the builder is going to take care of all the financing from the dirt all the way until they finish the house. They want to make sure that you, the buyer, can qualify for permanent financing, which is like a traditional loan. So that way, when they build your home and it's time to close, what happens is you already have your permanent financing pre-approval in place and you can just buy their new existing home the same you would as a regular home. So that way they don't build that house in vain. They get 6 months down the road, it's supposed to close, you don't qualify. So majority of the time, those builders will take care of that for you. Now, it's always important to ask that question up front because in the event that your builder doesn't do it for you, the responsibility will fall on you, the buyer, to get a construction loan. So I want to spend a little bit of time on construction loans and explain to you kind of how this works in the event that you have to do a construction loan to build your own house, okay? So first and foremost, you know, most of the time when it's required to ask the buyer to not only, you know, get a builder, get a developer, buy the actual property, but take on the risk of the home loan for the new construction, the lot, and the land, that's usually on high-end custom home build jobs. So let's say you were going to get a $1.5 million house and you wanted, you know, this many square feet, this many bedrooms, this custom pool, right? These custom home builders will do it for you, but they're not mass home builders like the D.R. Hortons and like the Grand Homes. So they're most likely going to ask you to go obtain financing from a private institution or a mortgage company that specializes in, you know, construction loans. Now, it's not always that way, but majority of the time, you know, the higher end custom home builders are not in the business of mass producing like your Lennars and like your Highland Homes. So they don't have a lot of money on the back end to be able to provide those loans for their buyers. They're specialty niche home builders, and so what they do is spend most of their time customizing the build of the house, but they want to stay out of the money piece. So if you are dealing with one of those high-end construction properties, you're going to be required to go to the bank and get a construction loan. So what does that look like? Well, there's a couple more layers to a new construction loan than there is when just buying an existing home, because you have to do two things on a new construction loan. Number one, you have to buy the lots, the land, the dirt that the property is going to go on. So let's say, you know, the land, the dirt, or the properties, call it $300,000. And then what you have to do is you have to get with your builder, and you have to put together specs and plans, and you have to put together a budget and cost. So let's say it takes you a month or two to do all that. And then you say, okay, great. So my builder is going to build me a house, and this house is going to cost $500,000. And then of course I've got to buy the lot as well. And so the lot is $300,000. So I need a total loan from a new construction lender in the amount of $800,000. Now, you go to this new construction lender and say, hey, I'd like to get pre-approved. Here's the lot and the land that I want, 123 Main Street. Here's my home builder. Here's the specs and plans for the house. Here's the scope of work. You put it all together. They pre-approve you. They also pre-approve the builder to make sure they agree with the scope of work, the cost. The builder is a strong builder with good insurance, making sure there's no pending lawsuits, making sure they're really on the up and up, and they'll check some references on that. So that may take you some time. It may take you a month to 2 months to get everything squared away specifically with the builder. Because remember, when you go to a bank, you just can't tell them, hey, I want a $500,000 house, and they give you a check. They got to look at all the materials, all the labor, all the details on the builder side to make sure they're protecting you and protecting themselves from inflation, from fraud, or even getting involved with a builder that's not maybe aware of what they're doing, and they don't want things to get delayed, so they're there to protect you. So that's a common way that everyone does it. They wrap it all into one building cost and land cost, and then what happens is after that part closes, your builder will have what's called a draw request. So a draw request is the builder says, hey, I need $500,000 for this home. I need $100,000 to do the plumbing. I need $100,000 to do foundation and sticks. I need $100,000 to do drywall, sheetrock, roof, X, Y, Z. And so as you move the ball down the field and complete the house, every time the builder completes a phase, they will ask that bank for money. Now the bank already knows what they're going to ask for because they put together that scope of work, so there's no big surprises. But as you continue to complete the house, you get further and further down the line, the builder will ask for some of that money, and then once it's completed, everything is done. Now, here's the part about a new construction loan that you really got to get with a new construction mortgage advisor on, because there are two types of construction loans. There's a one-time close and there is a two-time close. There are pros and cons to both. A one-time close is you get everything done up front. You get the land or lot money, you get the construction money, marry them together. It's an $800,000 loan. You put your down payment of whatever it is, and then of course the builder completes the property. Now, once that construction loan is completed and your house is permanently fixed, if you took a one-time close, your construction loan goes away, and then what happens is your loan automatically converts to a 30-year fixed or whatever it is at that point in time, and it sticks, the new terms start, and you're good for a 360-month term. If you take a two-time close, what that means is you do the construction loan and everything up front, but when the time comes that the construction loan expires, it doesn't automatically convert. You would have to go either back to that lender or find another lender and refinance and get rid of that construction loan, because obviously it's matured, it's done, and it has to go away. So on the one-time close, it automatically converts because the bank that you're doing the deal with is going to convert it and keep it. If you do a two-time close, it doesn't automatically convert. You have to go out and get a second loan for a refinance, and then you have to refinance off of that construction loan onto a permanent loan. Now, pros and cons of one-time close versus two-time close. One-time close is a little cheaper on fees. Two-time close, more expensive on fees. However, on a one-time close, the appraisal is done one time up front, meaning when you get all those materials and everything together, it's $800,000. They do the appraisal right then and there, and then they just do a completed appraisal at the very end. So if the property value has gone up, you can't really use that to your advantage from an equity position or a loan to value to get better terms. It is what it is. On a two-time close, obviously you're getting a refinanced loan, so that new lender is going to want an appraisal. So if the market has gone up and now that $800,000 house is worth $850,000, they're going to let you use that equity, and that can really play into the terms of the loan, because now you've got a better loan to value, and therefore you may get a cheaper interest rate. However, on the flip side of the coin, if for some reason you started that $800,000 house and it took you 9 months to build it, and now the new final appraisal for the two-time close is $775,000, whatever that delta is, that's lower at the very end from when you started, you as the buyer are responsible for that as well. So I'll do another video on this some other time about more specific pros and cons, but these are just some baseline things to think about. Last thing is, people say, well, what if I don't have the specs and plans and everything ready with the builder yet, but I want to take down the land? So those are just land loans. They're lot loans. What you do is you just go to a general bank or somebody that specializes in land and lot and say, hey, this lot over here is $100,000. I'm going to build on it. I don't actually have my builder yet. I don't actually have my developer yet, but I want to make sure and take down this land so it's mine. And then I will go find my builder, have a conversation with him or her, put together full specs and plans, and then we'll come back and get a construction loan. So if you don't have the luxury of doing it all in one at the beginning, like I mentioned, you can go get a land loan or a lot loan. It's very common. People just want to buy the land for $100,000 and take it down. By take it down, I mean secure it and hold it so it's theirs, right? So nobody else gets it. And then they spend 2 or 3 months interviewing home builders, trying to figure out exactly who they like, what style they want, pay attention to cost and pay attention to completion time. And then at that point, if they've got a land or a lot loan for $100,000 because they bought that land or lot separately, and all of a sudden their builder says, okay, now it's time to do a $400,000 construction loan, what would happen is you would go back in and you would get a loan for $500,000 all in one. So what it would do would be the $400,000 for the construction loan, and then the $100,000 that's left on the lot loan, you would wrap them together all in one and start the construction process. So listen, hopefully you found this video useful. If you did, do me a favor, subscribe, comment, like, share this with somebody that you know that needs this information. And if you just want to set up a mortgage planning session to talk a little bit further about your personal situation, maybe your journey for home ownership, or just have any financial questions at all, call us, email us, text us. We're always here for you. Until next time, stay tuned.